Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged, where my goal is to give you the clarity, confidence, and courage you need when it comes to investing like or investing with one of the top traders in the world. And I also want to acknowledge you for taking the time out of your busy day to spend some of it with me and today's guest. Almost every day I wake up to a new message or email with very kind and encouraging comments about the podcast. And trust me when I say, this really does mean a lot. So thank you very much. If I could ask you one favor, it would be to share the podcast with your friends and colleagues via email or social media. Not only will it help me, but it will also help all of my previous and future guests, as well as yourself, since the bigger the audience, the more great traders would like to come and share their stories on the podcast. So please take a moment now to share the podcast with a handful of your friends and colleagues. On today's show, I'm talking to Mike Harris, president of Campbell Company. Mike has an unusual background in that he has been involved in the managed futures industry ever since he left college. So he knows this area pretty well and has some interesting observations about the strategy as a whole, in addition to how Campbell Company has been able to navigate this approach for more than 40 years. In fact, it's hard to find anyone who has been offering a managed future strategy as long as Campbell Company. Needless to say, I feel honored and privileged to continue to bring guests with this kind of depth and knowledge to my podcast and share their stories with you. And if you want to read the full transcript of today's episode, just visit the toptradersunplugged.com website and click on the link of today's episode. Now let's get started with part one of my conversation. I hope you will enjoy it. Mike, thank you so much for being with us today. I really appreciate it.
Oh, thanks for having me.
Mike, I think it's fair to say that many people who are involved in the hedge fund industry, and certainly people who are involved in the managed futures industry, is very familiar with Campbell Company. And your founder, Keith Campbell, of course, who really, in my mind, pioneered this approach, which we know today as the CTA or managed futures strategy. But before we get into the story of Campbell, I wanted to ask you a completely different question. A question that I sometimes struggle with myself in answering. And it goes something like this. Imagine that you're invited to a cocktail party with people that you don't know. And after a few minutes, someone will come up to you and ask, "So Mike, tell me what you do." How would you respond? How would you explain what you do?
Well, that's a great question, and it's one that I'm sure that we all get quite regularly. In fact, it's funny. I still have a hard time after all these years explaining to my own mother what I do. I think she still tells her friends at cocktail parties that I'm a stockbroker, and that probably is the reason why I get emails from relatives asking me what I think about Microsoft's earnings. But when I'm faced with that question, I think the answer that I give them is that I'm Mike Harris. I'm the president of Campbell Company, which is a systematic investment manager that happens to specialize in a very unique asset class called managed futures. And at our core, like many investment strategies, what we're really focused on is using data to propel trades in a rule-based fashion. So instead of using the fundamentals and being a discretionary type manager, we are using systems to help us trade the global markets in an active long-short fashion.
Absolutely. Well, I want to stay with you for a little bit longer. So I want you really to go back and tell me your story, how you got into the business in the first place, and perhaps what you were like as a kid, what were your interests, how was it to growing up. So please feel free to go back as far as you want.
Well, unlike many of the students when I started in undergraduate studies, I knew exactly what I wanted to pursue from my first day in college. I had a plan. I knew that I wanted to major in economics and Japanese because I thought that both of those would be disciplines that would help me pursue a career in the financial markets. It's funny that you mentioned childhood. I actually had my maternal grandfather was loved to invest, was always doing different things in the stock market, and in fact bought me a stock when I was very young in Topps, which is a company that made baseball cards.
Wow!
Because I used to collect them, and he bought me that stock, and every week when he'd come to visit, we'd sit down with the Wall Street Journal and we'd track the stocks. And I remember, I'll never forget, 6 months into it, I got my first dividend check, and I was pretty excited about that. And I just never forget him explaining to me that I owned part of that company, and that as they made money, they shared their profits with me, and that's why I got that special check. And that really, for me, was where it all began, and how I started to plan my academic career around pursuing a career on Wall Street in the financial markets. As it turned out, I think it's really interesting to mention that I'm one of probably the few people in our industry who literally have been part of managed futures since the first day when I started on the street. I got a job with Dean Witter Reynolds in New York City in the World Trade Center, working in their managed futures department, and literally started, I believe, about 2 days after I graduated from undergraduate studies. From there, interestingly enough, we were an allocator, and we had money invested with Campbell Company, as well as John Henry and a number of other kind of legendary CTAs. And so my baptism was very early in the space. I then, kind of through doing due diligence on managers, caught that market bug that so many do, and realized that my calling was to be on a trading floor or a trading desk. And went across the street to the World Financial Center to work for Revco, and was working in a department that had allocated money to a number of CTAs and macro hedge funds. And so I actually was covering many CTAs, including Campbell Company, as a futures broker.
Sure.
And then a short time after that, as I kind of saw the industry becoming more electronic and realized that my value as a broker was somewhat limited, I was drawn to the buy side and really wanted to know when I picked up the phone and it was a CTA calling, they wanting to buy 10-year futures. I was, really taken by. I wonder what's happening systematically that's causing them to want to put that trade on right now. And so, as I looked to interview for jobs on the buy side, Campbell was one of the firms that I approached. Fortunately for me, they needed a European shift trader, and I joined Campbell Company about 15 years ago in the year 2000. And then through my 15 years here, I progressed from European trading desk to the currency 24-hour day operation, then became deputy manager of the trading floor, became global head of trading for a number of years. And then 2 years ago, as we were going through our third succession plan, myself and Will Andrews, who's our CEO, he was our co-head of research. The two of us took over the firm. And for the last 2 years, since 2012, I've been actively helping to manage Campbell Company.
That's fantastic. Great story. And by the way, great gift that you received back then. I have to say that that's inspiring.
He was a special man. Thank you.
Absolutely. Now, I mean, your story, I think, is fascinating. But the story that I very much would like to dive into with some level of detail is the story of Keith Campbell and the firm that he created back in 1972. And let me try and set the stage a little bit from my perspective, because what fascinates me when I think about managed futures is really 4 big stories come to mind. So we have the story of the turtles, we have the story of AHL, and we have the story of John W. Henry, and the story of Campbell. And I know I may offend some well-known CTAs by not mentioning them in this context, and if that's the case, then they can reach out to me and set me straight. But the fact is that both the story of the Turtles and the story of AHL has become quite well known over the years, and of course John Henry was always covered in the press when he was active. But the Campbell story, which in fact is the longest of all of them, has not really, in my mind, been covered as much in recent years. So I'm really grateful for having the opportunity today to share this with our global audience, and really would like you to take the stage here and tell us how the story unfolded 42 years ago and what the evolution has been so far.
Well, I'm happy to do that. And I think just to address one of your points, one of the reasons that the story hasn't been told as much is that Campbell Company, from our very beginnings, we've always been raised as a humble organization. We've tried to kind of fly under the radar. At the end of the day, the people that matter the most are our clients, and we want to make sure that they're happy. It's not as much as far as making sure that the media and the general public is as happy. So, but I really appreciate the fact that you have noticed the fact that we haven't been talked about as much, and have given us this opportunity. So, interestingly enough, I wanted to. This is an interesting story regarding Keith's how he began. I've heard this story told many times, and
Sure.
it's honestly one of my favorites. Keith started in the financial markets out in California. He was a financial advisor / planner in working with clients, and he, like many people in the 60s, caught the bug for commodity futures. There was quite a bit of volatility in those markets, and it was something that he was really attracted to. He started actually managing client portfolios in the futures markets in the late 60s. And interestingly enough, he had a client who was a PhD who worked at the Stanford Research Institute.
Right.
And they started having conversations about how Keith was trading the futures market for this particular person's account. And he was explaining that he was following the charts. He was in those days using graph paper and a ruler. And this PhD was talking to him about this wild concept, which was a computer. In fact, the mainframe computer at Palo Alto, and how he had access to this. And so as they kind of put their minds together, they thought about how could they take Keith's technical approach and create a rule-based system that the computer could effectively run on their behalf. And that's really where it all began. In fact, they started with the beginnings of Campbell Fund Trust in trading that portfolio in 1972 using this very basic system. And then really, Keith Campbell made the decision strategically at that point to come back to Baltimore, where he was born and raised. And in 1973, he got his brother Kevin, as well as Bill Clark, one of his cousins, who later became one of our early heads of research, and really put together Campbell Company. That's where the name comes from, and got things started. As Campbell progressed over the years, one of the keys, I think, to Keith's success, and one of the things, quite frankly, that makes him different than many of the other CTAs, is that Keith himself was not a quant. He was not some sort of a scientist or somebody who was kind of the brilliant mind behind it all. In fact, I'd say he was much more in the camp of a real innovative business leader. And one of his guiding principles was the mastermind principle. He believed that the power of when you take two minds and put them together, you effectively create a third mind, almost an invisible mind that then there's a multiplying effect of putting all of these smart people together. So he went out and began to hire very intelligent people, in some cases other PhDs, to really work together and create a research culture that then has grown over the years into what we now know as Campbell Company. I think it's interesting that after the first 20 years of Campbell's existence, even then, with all of this experience and being one of the biggest CTAs, certainly one of the oldest, Keith knew that he needed to hire somebody not just on the PhD side, but also on the business side. And so he went out into the futures markets and he found Bruce Cleland. And a lot of people in the industry remember Bruce Cleland as somebody who was at the time running Rudolph Wolf, which was a very large futures brokerage operation up in New York. He was somebody that had been around the markets and really understood futures and the business. And Keith brought him down to Baltimore to run Campbell Company as our president and CEO starting in 1993. And so Keith then passing the torch on to Bruce for the next 20 years. And certainly Campbell had a lot of success from 93 to 2012. And then in 2012, Bruce made his retirement. And as I mentioned before, Will Andrews and I, after both having been at the firm over 15 years, took on the reins as president and CEO.
It's funny you mentioned Bruce Cleland in 1993. In fact, Bruce Cleland came to my humble offices in Copenhagen in 1993, and what was so great about it was really, as a memory at least, was really that Campbell at the time was very dominant, and to have someone like him, so prominent within the industry, within your firm, actually take the time out to come and visit a small aspiring company in Scandinavia that wanted to get into this space is something that I has never forgotten, and I think that says a lot about Bruce and the culture that you have. So that's quite interesting for me on a personal level. What are the big, if you look at that 40-year or 42-year period, I know you mentioned there's sort of been three, leaders or teams at least. What are the big, would you say, stages or events in that 40 to 42-year period, would you say, before we get into the specifics, but just sort of on an overall basis?
Well, I think probably one of the big challenges, I don't want to speak for Bruce, but I can only imagine after joining the firm in 1993, we went into one of our larger drawdowns in 94, 95. That was a challenging period for the firm for sure, and I'm sure it was something where he probably at that time, I'm not putting words in his mouth, sure, but was maybe second guessing his choice to leave New York and come to Baltimore. But with his real strength and fighting spirit, he hunkered down. He knew that really the focus needed to be in the area of research. He made some real strategic hires. In fact, Dr. Shawa Hugh, who's our current director of research, has been with the firm 20 years and was one of those strategic hires that was made in that 93-94 period when the firm went into that drawdown. And I think that's really been kind of one of the real watershed moments for Campbell Company, where we learned that in periods of difficulty, the best thing to do is to reinvest in the business, to kind of put your nose to the grindstone and just fight through it, as opposed to, a lot of people with MBAs will tell you that as from a business standpoint, when you go into a tough period like that where AUM declines, revenue goes down, you want to do the opposite. You want to kind of protect the business by, shedding employees and really kind of hunkering down and trying to get through it. I think that in our business in particular, when you go through those tough periods, if anything, you need to show signs of strength, that you're reinvesting in the business and that you are, here for the long haul. And I think that the fact that the firm at that point was over 20 years mature helped them to be able to do that. Maybe if that struggle had come in the first couple of years in the 70s, I don't want to speak for Keith, but maybe it would have been more difficult to make that investment in the business. And I think that then kind of dovetails nicely as you look at kind of the most recent 5 to 10 year period. Certainly we as a firm went through our struggles in kind of the 07-08 period, with a bit of underperformance relative to the industry. And looking back into that kind of crucial period in the 94-95 cycle, we took the exact same approach of really kind of surrounding ourselves, reinvesting in the business, and working hard to kind of get back to our footing at the top of the industry. And I think that if you look at performance over the last 4 to 5 years, you'd agree with me that we have kind of gone back to being one of the key players in the space. So I'm really proud that the firm was able to do that.
Sure, absolutely. Yeah, no, that's very important to bring that up. Before we leave sort of Keith's early beginnings completely, in my recent conversations with Jerry Parker and also with Martin Lueck, we talked a little bit about what the early models for the Turtles looked like and what the early models of AHL looked like. I don't know whether you know this, but I'm just curious what the very early beginnings of Keith's technical trading was based on, and also how he got the idea to apply rules to trading, because I can only imagine that back in the 60s, not many people were thinking like that.
Well, I think that in talking to Keith, he's always said that I think because he really was a lover of the charts and believed in the technicals, there was always that kind of rule-based approach. Though systematic trading in CTAs is not always based on explicit technical analysis, there are a lot of similarities. Just in the sense that when you say as a rule, if the market, if we're going to when the 50-day moving average crosses the 200-day moving average, I'm going to enter or exit a position. I mean, that in itself is a rule, and by kind of writing that down and holding yourself to it from a risk management standpoint, it creates a return profile over time that's way more repeatable than just kind of playing Monday morning quarterback and sitting there and making different decisions with every tick in the marketplace. So from talking to Keith, I really believe that is something that was always at his core. And I think that when you think about the early days and what those models look like, for sure, Campbell Company was a trend follower. Yeah. There's no doubt about it. In fact, if you think about time horizons, I'd say that we were a medium-term trend follower. We certainly weren't looking out beyond a year, and we weren't very short-term. I think that operationally, as well as from a Sharpe ratio standpoint, back in the 70s, you definitely, there was an advantage to having less turnover in the portfolio, and medium-term trend following certainly helped with that. And I think that really is the interesting part of the story, is that Campbell, though there's been a lot of press recently about what we've been doing in some of the non-trend following models that we've developed. When you think about it, we really got into non-trend following with the evolution of trading FX carry strategies, and we started doing that in the late 90s. So we've been at that for over 15 years, and what we've tried to do is really just enhance the non-trend following portion of our portfolio to help diversify for times where, and to be quite frank with you, there are periods where trend following doesn't work as well. We wanted to, as an absolute return manager, add things to the portfolio that were going to help diversify, so that in those periods where trend following didn't work as well, we would have a more stable return profile for our clients. So, there's been quite an evolution over the 42 years.
Sure, absolutely. Now, I wanted to ask you a slightly different question, and that is that you, as the president of Campbell Company, obviously that's a big part of your life, but what do you like to do when you're not working? What do you like to spend your time doing?
Well, I'm an avid reader. I've always criticized young people coming into our business who say, how could I have any experience? I've never had a job before. And when I talk about experiences, I say, yes, but I feel like the financial markets are probably second to history and military in the sense that everybody who's ever traded anything seems to have written some sort of a book. So there are a lot of experiences that you can gain as an individual by, quite frankly, learning from the mistakes of others through kind of reading their stories. So I've always been a huge reader. I also enjoy sports, and in the most recent kind of 10 years chapter of my life, I really enjoy spending time with my family, including my two kids.
Yeah, no, fantastic. Now, before we jump into the next topic, I wanted to ask you a slightly broader question, and that is, we know that many of the most successful managers today really have been based around its founder, an individual, and the firm is often personified with this individual. But in your case, your founder stopped a long time ago running the business, as you've explained. What difference do you think this makes in terms of Campbell as a business from an internal point of view, but also Campbell as a business partner to an investor?
Well, I think that one of the great benefits of systematic investment managers is that we remove key man risk from the equation. And one of the things you hear talked about all the time in discretionary macro is what happens when, Paul Tudor Jones or George Soros or any of these real visionary traders, what happens when they leave their firm? And I think that on the discretionary side, they've worked really hard to build teams, to allocate risk to those teams of traders, to teach them their ways, but there still is a bit of a fear when that principal kind of exits the scene and leaves their name on the door, but isn't present on the trading floor anymore. And I think that the real benefit of our strategy is that most folks understand the fact that the models are the ones that are executing the trades. Now, that being said, I think we all can acknowledge that many of the legendary CTAs are started by, as I said, a quant or a scientist who is they themselves kind of the people that are building the models. So I guess to that extent, there may be a worry that when the founder decides to retire or walk off into the sunset, that the research itself may lose something. And I think that Campbell's in a very unique position, as I mentioned, because we were founded by a business person who had a financial background, not a quant, and by surrounding himself and really promoting a culture of team sharing of information, we've created a very sustainable business model where groups of people over time have worked here on our models, and even though those people may not stay with us, the models do continue to reside as our intellectual property, and as each new person comes to the firm, they help enhance that over time. So I feel that though all businesses have that risk, I feel that, as a CTA and specifically to our situation as Campbell, we have considerably less of that risk, as well as the fact that having been around for over 40 years and the fact that we've gone through these three succession plans, I think that also gives some faith to the investor that, as well as our employees, that we've executed on these transitions before, and that we know something about how to do it.
Sure. No, absolutely. It's very interesting. I mean, another well-known firm that's been around for about 40 years, Dunn Capital, they've done the same. They've been through their transition. So, maybe that's the mark. Maybe that's the mark when people start thinking about it. Who knows? But anyway, I wanted to ask if you could, because you have a number of different programs today, and just from even though we're going to talk about probably the largest of your programs as kind of the theme, I wanted to give you the opportunity to maybe just highlight from an overall point of view what your product offering looks like today.
Sure. So one of the things we've done recently is really kind of almost bifurcate the portfolio and create almost a menu-based approach. What we've heard over the years, if you think back to 10, 20 years ago, investors were still educating themselves on the space. They would come to us and say, please give me what you think is your best portfolio. We've come a long ways as an industry now, and in fact, when I'm out there as the president of Campbell meeting with a lot of institutional clients, in many cases, they've hired their own PhDs, and many of these folks have maybe worked at a CTA or had their own CTA in the past, or have allocated to CTAs and really understand all of the various alpha sources and drivers of return. So now what we find is that a lot of investors come to us. Some come to us and say, we want what you believe to be your best portfolio, which is our flagship managed futures portfolio. But in other cases, they may come to us and they're trying to build a fund of funds or a group of managers. And so they say, we just want your trend following, or we just want your non-trend following models, or we just want your cash equities, which for us is statistical arbitrage across the globe. So with that, as I said, we have a trend following portfolio where investors can get access to just our trend systems. We have what we call our Prism portfolio, which is just our non-trend following models, and it's the same portfolio that's in the flagship vehicle. Then we have, as I said, our flagship fund, which is our managed futures portfolio, which is the mantra behind it is that it's enhanced trend following. So it's an 80% allocation to trend following and a 20% allocation to non-trend following, or that Prism portfolio we just spoke about. And then lastly, we have our multi-strategy portfolio. And multi is what includes our equity stat arb. So there you have a 40% allocation to trend following, a 40% allocation to non-trend, and then a 20% allocation to the equity stat arb. And we believe that that's the most diverse offering that we can offer to institutional clients. But in many cases, if they're looking for something with a higher degree of correlation to CTAs, they're going to want our flagship managed futures portfolio. And then obviously, if they want to bifurcate that and invest in just trend or non-trend, we have vehicles for that as well.
And do you, I know these questions are hard to answer sometimes, but do you have a wish from a business point of view to say, okay, in the next 5 years, I really want to see us having at least 25% of our assets in this strategy and 25% in this strategy, just to become a more diversified, systematic investment firm? Or do you expect maybe that actually, the original managed futures will always be our core and always be maybe 75% of our business?
That's a really good question. I think as a business person, we're selling diversity here. So I would love to have more diversification across the various portfolios. That said, my fear is always that allocators from time to time will try to, trade managers or trade styles. And my fear would be that when trend following does well, people will allocate to trend following at absolutely the worst time, or vice versa to the non-trend following portfolio. And so at the end of the day, a tremendous amount of research has gone into both our flagship vehicle and our multi-strategy vehicle that both offers the diversification across trend, non-trend, in the case of multi, the cash equities. So I would feel more comfortable having the larger portion of my assets in those two vehicles simply because I think that they're going to have the longer, or the better, I should say, track record because of, the Sharpe ratio and the risk-adjusted returns that we've seen in the back tests.
Yeah, and I guess also it's quite interesting to see that many of the largest firms in our industry really are one product shops. I mean, Winton is one aspect and so on and so forth. I mean, they really are one product shops. So maybe it is also sometimes too hard for investors to make the right choice, and it's better that you do it for them. But interesting. Now, you've got a big organization. So I wanted maybe to ask you to explain a little bit about how the organization is structured from an overall point of view.
Sure. Well, our current assets under management is just over $4 billion. We have a staff of about 132 people here in Baltimore. We do have a few salespeople that live in various parts of the country and the world, but the lion's share of that 132 is here in Baltimore. About 80 people of that 132 are involved or touch the investment process every single day. And I think what's important to mention as well is when I think about diversity, and you just kind of brought this up as far as having the assets split amongst multiple products, but there's another layer of diversification via assets, and that's the types of clients that you have. If you have all of your clients are in they're all fund to funds, or they're all from one particular part of the world, or they're all retail or all institutional, that in itself gives you some concentration risk. And I think one of the things that Keith Campbell did a great job of in the early days was being one of the early movers in the private wealth distribution business. So we've been creating limited partnerships that retail investors who are accredited in the United States can invest in for many, many years. And that's taken the form of our business really being about 50-50 split between institutional clients and private wealth clients. And what's nice about that is that they tend to kind of move in and out of managed futures at different times and for different reasons. And that really, to be honest with you, probably gives us more diversification from an AUM standpoint than even diversification across various products on the institutional side. And I say that because getting into the private wealth distribution business is not easy. I think one of the reasons that we've been successful is because of our size. Oftentimes people, compare us to other CTAs who may have a slightly lower headcount than 130 at $4 billion under management. But I'll often remind them that, part of, I think, what makes us special is that private wealth piece. And without the 130 employees, we would probably find it very difficult to do that level of retail distribution. So I don't think it's an apples to apples comparison to look at a $4 billion CTA that only has institutional investors, if that makes sense.
Yeah, no, it makes perfect sense. It's a very good point. In fact, it's something I wanted to bring up later, but I can't actually remember what my question is. So we may come back to this, which is a bit of a unique feature for sure. So you say 80 of the 130 is involved in the investment process, but do you nowadays with technology, nowadays with outsourcing opportunities, how do you view that? Do you outsource any of the things that you do, or do you really keep it in-house?
That's a great question. So right now, there's limited outsourcing when it comes to actual people, but where we are seeing some unique outsourcing opportunities would be in technology.
Right.
And this is really something that as a firm, it's been a real transition for us. Really, when you think about it, 20 to 40 years ago, there was no vendors on the technology side that could provide anything that we needed to do our business. And so another element to our higher headcount is that we have a very large technology team, because to be quite honest with you, we've had to build all of our systems going back in history.
Right.
In the last 5 to 10 years, we've seen that change dramatically. Although many technology companies initially focused on what I'll call the big asset classes like cash equities and fixed income, what we've seen recently is that they've started to migrate into what I'll call the hedge fund space. So they've embraced futures and options, OTC markets like cash currencies and swaps. And so with that, we've now seen a whole host of products that we can use to help us be more efficient. Because at the end of the day, we're still going to need technology resources like software engineers, but I want those people focused on our intellectual property. I want them working with research to build better alpha sources, not working in the trading department to build a better blotter for the traders to use to route orders out to the marketplace. And so that's really been our focus as of late, is embracing outsourcing of technology in areas like accounting, operations, certainly the back office, and then the front office on the trading side.
Sure, absolutely. Now, I don't know whether it's best to use the research team as an example, but what do you look for when you want to add people to your business or your research team? What are the things that you look for in the people you want to join the Campbell family?
It's a great question. I mean, I think if I could summarize it, we're looking for strong, creative, critical thinkers. And where we get those people from, I think that's a bit of the secret sauce. I think that you're putting all your eggs in one basket if you just go to other CTAs or to the banks and just bring people in who have an understanding of the financial markets. I think that you do want to have some of those people as part of your team, but we've also always believed that there are some really interesting people that you can pull directly out of academia. There are some folks that may even be working that have a PhD, say, but are working in another discipline, say physics or other disciplines within science. We've even had some success in hiring people that had maybe a medical background. I remember one particular gentleman who was working at the University of Chicago analyzing brain waves. And at the end of the day, he said, well, how can you compare this to financial markets? And we said, it's just a piece of data on a chart. And maybe the ways that you're looking at it from a medical standpoint are different than the way we're looking at financial markets, and maybe there's something we can learn from that. So there are a lot of kind of interesting examples of people who have come from really unique backgrounds that help to kind of add value to the overall team. And I think that word team is really important, because going back to Keith and how he started the firm in the early days, that notion of he couldn't do it all by himself. He needed to bring the firm back to Baltimore to enlist some of his family members to create a team, and then using that mastermind principle to build out a team of very intelligent individuals. That's probably our number one focus, is is the person a team player? There are a number of people in our industry who have a hard time sharing their work with others. They believe that they came up with an idea and they don't want to run around and tell everybody else about it. That's completely anti to what we believe here. We want people that are going to work in a team fashion, share their ideas, not be afraid to be criticized by others in the group, because we believe that that's what makes the idea better. And at the end of the day, that's what gets that key man risk effectively, limits that key man risk, so that Campbell Company and its models can continue to live on into the future.
Sure. No, absolutely. I had one more question about sort of the organizational side, and that is a little bit about how do you build a strong culture in an organization like yours? What are some of the key things that you do to build that team and make the team work so well together?
I think at our core, it comes down to really the history that we have. I remember what Campbell was like when I joined 15 years ago. To be quite frank, it's a family culture. Yeah. We take care of one another, and though we work very, very hard for our clients to make our strategies better, I don't think it's the same kind of cutthroat environment that I was exposed to when I was working on Wall Street in New York. Sure. And I think that being in Baltimore from a cultural sense helps us to kind of slow down a little bit, be very thoughtful about our research. We don't have to rush everything to market. Like I felt that every deadline in New York had to be done by 5 o'clock, and sometimes work was rushed and what wasn't as good as it could have been. So I think that being in Baltimore and having that strong sense of family has always been a big part of our culture. And once again, I go back to everything being done in more of a team fashion. Sure. I mean, think about our leadership structure. It's myself as president and Will Andrews as CEO. We are co-running the firm, which means that I can be out on the road meeting with an institutional investor on the other side of the planet, and Will is back here running the shop, and vice versa. If he's on holiday, I'm here. We think about we have a very strong executive team with 9 members, total Campbell experience of over 100 years. Kind of average tenure is 8 to 20 years per individual. So when people come here, they obviously feel pretty strongly about the culture, because in many cases, we want those people that are looking to retire in Baltimore at Campbell and not jump from job to job like we see at many other firms in some of the bigger cities like New York, Chicago, and London. Yeah,
I guess that's definitely very very true. Now, I wanted to jump to more of the sort of the trading-oriented side of our conversation. But before we get there, I want to talk about track record. And I want to ask you a little bit about how people or how investors, potential investors, should look at your track record. And the reason I ask this is because we know that models evolve. We know that the trading models that Keith used in the 70s are certainly not the models that are being used today. So this is also a little bit of a kind of an educational question, and that is, how should investors approach looking at a manager with a long track record and make sense of it?
Well, it's a great question, and we start by always telling people that we're happy to show you our 42-year track record. But almost one of the first things that we caution people against is, be careful when you're looking at the 70s. Yeah. And for many reasons. First off, Keith would be the first one to tell you that I believe one of his early portfolios was about 12 markets, and they were all commodities. And commodities during the 70s, as we all know, during a period of aggressive inflation, had some very, very big moves. Sure. So though we had some very spectacular returns back in the 1970s, we try to manage people's expectations by telling them, it's a much larger, more diverse portfolio. Our group of strategies is much larger and more diverse than it was back then, with multiple styles and lookbacks and trend following and non-trend following. So that's one of the first things that we always tell people. Sure. I think when I tell people as far as looking at our track record, one of the things that I like people to focus on, to be quite honest with you, is the last 3 to 5 years. Right. And that's for 2 very important reasons. The first is, let's face it, the last 5 years has been a very challenging one for CTAs. And I think Campbell Company has done a great job of innovating and building and adding new strategies to the portfolio mix that have really helped us to outperform. I'm very proud of that. And so I certainly want people to focus on that because I think that sets the bar quite high. In addition to that, we've made many enhancements to the portfolio since that 07, 08 period. And I think that it's important to look at the portfolio because the way it is today, it hasn't changed a whole lot, in the last 5 years. But, since that 07, 08 period, there were changes that were added in after that period of underperformance that have changed some of the dynamics of the portfolio. So I think if you really want to be laser focused on what that portfolio is going to look like in the future, focusing on the most recent period is probably the most applicable. And if I could, since we've mentioned some of these changes, if I could just summarize them, as I mentioned before, one of the first changes we made on the back of kind of the 08 period was to change the investment objective. Okay. One of the reasons we underperformed was we had a much healthier balance between trend and non-trend in the portfolio. And though we were positive in 2008, we didn't have as high of a return profile as some of the other CTAs that were more focused on trend following. And what we heard from investors was that that's in fact what they were looking is for that bias to have a reasonable correlation to other CTAs. And if other CTAs were going to have a lot of trend following in their mix, or in some cases 100% allocation to trend following, we knew that we had to have that bias as well.
Right.
So we set the research team off on an optimization project to come back and tell us what they thought would deliver what we call now enhanced trend following, and 80-20 was effectively what they arrived at. So, that change was made post 08, and we've stayed at that 80-20 allocation since that period. In addition to that, we've added several new forms of trend following. Going back to when Keith started the firm in the 70s, we focused on what I'll call market-based trend following, which is where you're following the underlying signal of each and every market in the portfolio and effectively mapping a long or short position to the strength of the uptrend or the downtrend. Now we've added both what I'll call sector-based trend following as well as factor-based trend following. Sector-based trend following is where you actually think about the intuitive economic movement of markets and what makes economic sense as far as grouping markets together to kind of lose some of the noise of individual market moves and then effectively create an index around that grouping of markets and trade them as a basket. I think one of the most interesting things about sector-based trend following is in an environment over the last few years where many CTAs complained about the rise in correlation between markets, which in a market-based sense effectively limited their opportunity set.
Sure.
A model like this actually did quite well because as investors moved in and out of risky assets, as an example, instead of seeing trends in, say, WTI crude or Brent or unleaded gasoline futures, you actually saw just investors moving into commodities like energies and moving out, and it created sector trends that these models were able to follow. So I think that was one of the areas where we saw some outperformance.
Sure.
The next one was the factor-based trend following. Now, factor-based is similar to sector in that still trading baskets of markets. The difference here is instead of upfront deciding what the basket's going to look like based on an intuitive economic sector, here you're actually using correlation to tell you, okay, instead of what markets are, should be trading together, what markets are actually trading together.
Right.
So it's a similar approach, but going at it from a different angle, so to speak, and using that correlation matrix.
Sure. That's very
Next
interesting.
was really to enhance our lookbacks. So as I mentioned, going back to the 70s, we started as a medium-term trend follower, which I would define kind of loosely as a 1 to 3 month look back.
Sure.
And as we did more and more research, we saw that maybe there was value in adding both shorter-term look-backs, 1 month and in, and longer-term look-backs, kind of 3 months out to a year.
Sure.
Though we still have held on to a kind of a core allocation of medium-term trend following because it has the best Sharpe ratio over the long term. We really like the diversification benefits of, say, the shorter-term models, which helps us in a trend reversal period to actively turn our portfolio quicker. But we've intentionally lowered the allocation to short term because, in fact, you've always got to watch your trading costs, and in some environments you can get whipsawed. So it does have the lowest risk-adjusted return of the 3 lookbacks, and so we've underallocated a bit there, but we like the value that it brings to the portfolio. And then in some cases, the what I'll call the anti-whipsaw, which is the elongating your look backs so that you're not seeing as much turnover, that you need a very long mature trend reversal in order to get you out of your position. Certainly the longer term models have done quite well in recent years, in that in many cases, whether it was risk on, risk off, or taper on, taper off, if you were, say, long equities, you stayed long equities, even though there may be a 2-week or a 1-month reversal in stocks. It took so much more to get you out of your position, so you held on to it. And I think that, at our core, we believe in diversification, so it wasn't about deciding which of these 3 lookbacks was the best, but really introducing these 2 new lookbacks in the short and long term to help complement the medium-term models.
Yeah. Well, it sounds like you've been very busy on the research side in recent years. Would you say, just not that it's that important, but would you say that the last 5 years is where you've just gone through some major improvements, would you say that that's probably been one of the most sort of the busier periods in terms of research upgrades and really evolvement of the strategy?
I think we've always been extremely active in the research process. As I mentioned before, in recommitting ourselves to research after that 94, 95 tough period,
sure.
We've always believed in research, and it's always been an active process. I think that it's much more that we made more significant changes to the construct of the portfolio post the 07, 08 period, because we really had to respond. As you and I have discussed, we saw a significant outflow of assets. At our peak in 2006, we were at 13 billion, and just a year and a half ago or 2 years ago, when I took the role, we had declined to 2.5 billion. So. In seeing those types of outflows. Now, granted, I think we both can agree that some of that was just based on the financial crisis.
Sure.
Like many people, had investors on the institutional side in particular that had significant liquidity issues. And one of the best selling points of commodity trading advisors is our liquidity. And so as the joke goes, we were the ATM of the hedge fund industry, and everyone came to get liquidity and cash from us.
Yeah.
Now, the other half of that story is that we underperformed our peers in those periods in 07 and 08. And that also led to, if you're going to take the money from someone, maybe you take it to the worst performer during the period. And I think that we haven't talked about 2007, but there the story was different. There it wasn't as much kind of the balance between trend and non-trend. There, in particular, as we talked about, Campbell was really a pioneer in adding FX carry strategies into a CTA portfolio back in the late 90s. And it worked quite well for us. In fact, in many years between, say, 03 and 06, a lot of our outperformance came from FX carry. And in 07, as we saw the beginnings of the financial crisis and that high period of risk aversion, FX carry was one of the first things in many people's portfolios that were liquidated. So we did see some losses as a result of that, which led to some of that outperformance, and then propelled additional changes on the research side and in the portfolio. One of the things was we moved away from naive carry and said that we're not going to have a carry strategy in the portfolio unless it has an enhancement or an overlay or a modulator that will help it in some of these difficult periods of risk aversion. We also look to build out our non-trend following suite of models away from just carry and in carry, not just in the asset class of currencies. So we added cross-sector models, which take information from one asset class and use it to propel trades in others. The investment thesis there is that information, we believe, is disseminated at different points in time from one asset class to the other, and so that there's information that can be gained, say, in equities that would allow you to trade currencies, and there are many examples. We also added in short-term mean reversion, where there we believe that short-term mean reversion can help in several cases, but most importantly, after a long mature macro trend, oftentimes you see not only the reversal, but sometimes a period of choppy price action before you break out into a new up or down trend. And so having short-term mean reversion in your portfolio actually gives you a strategy that can specifically perform in that environment, which we all know as trend followers is usually the worst possible environment for a trending system. So continuing to kind of build out that non-trend following suite, helped. And to be quite honest about short-term mean reversion, when I say short-term, I think I do need to clarify that
Sure.
though these are the fastest models in our portfolio, they still only represent about a 1 to 2 week look back. So
Sure.
they're faster than a 3-month medium-term trend following system, but we in no way have moved into the high frequency intraday trading type world.
Sure.
And that, but I will say from a CTA perspective, it has made us more nimble.
Yeah.
I think if you look at last summer as an example, when many of our peers had difficulty during that kind of May through September period after Ben Bernanke on May 22nd said the T word or taper, and the correlation between stocks and bonds broke down dramatically, and many managers lost on both their longs and stocks as well as bonds. We saw specifically some of our faster strategies like short-term mean reversion very quickly covering our bond position, and within a matter of about 2 weeks, we were effectively short bonds and had a hedge on over the summer months. So we gave back a little bit, but of our gains for the year, but not these huge losses that we saw in other parts of the industry. Now, to be fair, at the beginning of this year, we underperformed a bit in the first quarter because those same nimble strategies, when the equity markets corrected in January, reduced our risk so that when stocks went back up to the highs in February, we didn't have the same equity position that many of our peers had. So I think at the end of the day, once again, it's about being correlated to the industry, but also being different so that we can justify our role in people's portfolios.
I mean, I couldn't agree more with what you said. I think that's very important. I have a philosophical question from the things that you just brought up just now, and maybe it doesn't apply so much to you because, as you say, yes, you've gone longer term in equities because that's been a good thing to do. But you've also maybe added some shorter term models that kind of balances this out. But here's my concern a little bit. Because I hear that from many sides that many CTAs, if we call them that, have become more long-term because we know that has been a good way to enhance performance. And certainly in the equity sector, where, as you say, we've been in a bull market for 5 years and with very small corrections, so being very long-term has been the right thing to do. Here's my concern, though. If everyone is becoming more long-term, and in particular if we're becoming more long-term in equities, are CTAs going to lose the value that they play in the portfolio of managers or institutional investors who actually want CTAs to make money when equities go down? Simply, are CTAs in general going to be too slow to react, and are they all going to head for the exit at the same time? Given that, I know it's a bit of a philosophical question, and maybe you don't have a view on it, but I'm just a little bit concerned because I hear this from many sides about the time frame, and in particular in equities.
I know. I think it's a very topical issue and one that we hear a lot in the industry. So a couple of comments. First off, as I mentioned, because we have added both short-term and longer-term look-backs into we've in a sense embraced both of those elements. But right. I think that when you still look at the portfolio as a whole, it still is going to have a very kind of medium-term look-back because the short-term and the long-term balance each other out. As I said, if anything, the shorter term systems for us are nice because it helps us to kind of cover our risk and maybe turn the aggregate position a bit faster than just a medium to long term system. But because we have implicitly made that decision and see the value in adding in shorter term models, I'm probably on the other side of that argument. I do think that from a research perspective, one of the things that we're always focused on is looking at every change that we make to the portfolio and what impact it's going to have on our correlation or beta to the equity markets, to be quite honest. Because I think to your point, there are a lot of investors out there who look at their managed futures or their trend following exposure as tail risk protection for traditional assets like stocks. There's a reason that term crisis alpha is used quite a bit in regards to describing commodity trading advisors. And so I agree that we would not, as an industry, want to lose that, because I think that's a very valuable role that we play. In fact, it's funny that through this incredible uptrend that the Fed, if you're of that belief,
Sure.
or if you think that equities have been going up for other reasons,
Sure.
has created. Now, as it turned out, if I think about the most recent correction, it actually happened in what I'd say a much more gradual, although a few weeks ago it
Sure.
certainly felt a bit more violent. But if you think about over the last few months, the markets kind of came off the highs, and in our case, the short and medium term models had covered their long positions. The long term models held on to their long positions. So for us, we really just kind of got flat the equity markets just in time for the abrupt downside moves to kick in.
Sure.
And so as investors look to our performance, they actually saw positive performance, in large part because of the movement of flight to quality into bonds and our
Sure.
long positions there. Now, as I look at the industry as a whole, we are seeing quite a bit of dispersion this month, as an example, but across CTAs. And maybe to your point, that's because there were people that didn't get out of those long equity positions and struggled a bit as a result. I think it's going to take more time for us to really kind of realize that. But
Sure.
at the end of the day, I don't think it's a bad thing necessarily that managers in our space start to kind of, as I said, do things that are a bit unique and different and try to differentiate themselves. Because if everybody has, a 95% correlation to the largest managers or to the Barclays CTA index, then it's going to be really hard for people to be able to pick and allocate to managers.
Yeah, absolutely. I mean, I think there are two thoughts on that. One is, of course, that we know nowadays that investors predominantly feel that allocation should go towards the larger managers. That's clearly why there are much fewer large managers and a lot more small managers who are struggling. So in that sense, it is also important that large managers do things differently and not become too correlated, as you point out. But the other thing is, of course, there's also a problem for the smaller manager, if we just talk about them for 2 seconds, and that is they think that investors only want someone who looks like a Campbell or who looks like an Aspect or whoever it might be. So they often design their systems to look like that. And actually, it's a bit of a shame, because what really differentiates a manager from another is the manager itself. And therefore, they shouldn't really try and look like anyone else other than what they really believe in. But it's a difficult thing to do in reality. Now, one of my listeners sent in a question that I think you might be really good at answering, and that is just, how do we respond as an industry to the fact that many investors, and maybe those who have left this space in recent times, who claim that the reason why trend followers don't really make as much money in the last few years has become simply there's too much money trading the same trends and there's too much money flowing into this industry. Do you have a thought on that? Do you get asked these questions on your side?
We were definitely asked that question a few years ago. I feel that question hasn't been asked recently, because, to be quite frank with you, in the last 6 to 12 months, CTAs have actually had pretty decent returns. Sure. And though the industry has shrunk a bit, it hasn't shrunk in a large material way. And so certainly, we continue to believe that there's efficacy in what we're doing because profitability has returned to the space. I think what will be interesting as well is to continue to follow the liquidity of the markets that we trade. And I think that, that to me, from a former trading standpoint, is the thing that I'm most focused on is, the markets that various CTAs decide to trade, right? So there's a debate as to how diverse you should make your portfolio and where you should have your cutoff point for liquid markets. I've been quoted many times as saying that we have 80 markets actively in the portfolio, and though we're always looking for new markets to add into the portfolio, we're probably on the lower end of the spectrum and a bit more conservative when it comes to making sure that we're trading liquid markets. Because I've said very frequently that when you have 200 markets in the portfolio, there's two risks there. Risk number one is that you're starting to wade into markets that may not be nearly as liquid. And then, as we all know, as traders, you tend to make money on the way up, but then when everybody exits the trade, you give back everything you made and then some. So it can lead to losses for the strategy. The other risk is that you're just really doing it to effectively, add a bigger number to the marketing brochure. And there, when I say that, I mean that you can add a whole lot of additional international equity futures to the portfolio. But if you're adding a particular market that's got a 95% correlation to the Nikkei or the DAX or the S&P 500, what are you really adding to the portfolio other than another name, on your website as far as another market to increase that number? And you're creating issues, for the portfolio and the traders because you could be putting something in that's not as liquid. So I think there continues to be a real debate there. I think in addition to that, there's been a real debate within the industry around how you weight your asset classes, because as managers have gotten, some of the bigger managers in Europe have gotten larger, we've seen them focus way more on financial futures. And I can only believe that that's because they are way more liquid than commodities. I mean, I had an investor recently kind of jokingly say that Campbell's putting the C back in CTA for the multi-billion-dollar space, because we continue to have an even allocation when we start the day to all four of the major asset classes. And I think the fact that we have a 25% commitment to commodities is a real differentiator. You certainly see that with some of the smaller managers, particularly in the U.S., like in places like Chicago. But for Campbell to have that much in commodities, I think it makes us a bit of an outlier. And listen, at the end of the day, we just see that there's some really unique opportunities. Commodities, we like to bucket them as an asset class, but when you think about it, between precious metals, base metals, energies, livestock, grains, even this subsector, soft commodities like coffee, cotton, and sugar, these are markets that have very, very different supply and demand forces, and when you're looking just within the commodity sub-portfolio, performance can be very different. So there's a lot of diversity and opportunities when you add commodities in a meaningful way.
Absolutely. I mean, this was one of the things I wanted to go into a little bit more. So I'm glad you took me there. Given the fact that, as you rightly say, trading 80 markets is certainly on the low side for sure, compared to the size of your portfolio and compared to other managers, and the 25% allocation to commodities. What does that do, if you want to stick to this, what does that do to your optimal size, meaning growth? I mean, where does that allow you to go? And maybe you don't have an ambition of being as big as some other managers. I don't know. Talk to me a little bit about that.
Sure. Well, it's a great question, and one that we get frequently from our clients and our prospects. As we currently look at our existing portfolio, and if we look at the markets that we're trading and assume that liquidity doesn't change, we could run our current portfolio up to about $10 billion under management. So we've got $4 billion currently in the portfolio. It means we have a lot of upside for growth. But if we're going to keep the allocation to both commodities as well as some of those shorter term strategies that I mentioned, we're going to have to, cap the portfolio. Now, a lot of things can change. You think about it, liquidity has come in quite a bit from the highs of 2008.
Sure.
If we were to see a return to a rising liquidity environment for fixed income, equities, currencies, and commodities, then that's going to change. But as I said, just kind of looking at where we are right now, we have room for growth. But at this point in time, we don't have, visions of being a $20 or $30 billion manager. Now, that said, I mean, we are always thinking about new products. And you mentioned earlier about, diversifying yourself across, different product sets.
Sure.
We've been trading cash equities in Stat Arb for a number of years. If interest were to come back into that space, that could be a portion of our business that would allow us to grow as a total firm AUM, but wouldn't impact effectively our CTA AUM. So, there's a lot of different factors at play. We want to make sure that we can grow. But I think that, being a multi-billion-dollar firm gives us a tremendous access to resources to create an institutional infrastructure that allows for, redundancy, processes and plenty of headcount, legal and compliance to be able to deal with all of the challenges that, as you mentioned, smaller CTAs struggle with today. And so we like being kind of in that billion-dollar group. But at the same time, I think that many institutional investors look at us as somebody who has growth potential, whereas maybe some of the larger managers, they do fear that, how much bigger can they get before it degrades their returns.
Yeah, no, absolutely. I wanted to talk a little bit more about the trading program. And in some ways, I wanted to give you kind of the opportunity to take us where you want in terms of describing or what you want to mention about the trading program and so on and so forth. But I want to mention one thing that I noticed that I think is certainly an interesting topic, and maybe that's something you want to comment on, and that is how you create a strategy, because maybe it's a bit difficult for many people to really understand how
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.